My name is Marcus, and in over 40 years of managing institutional money at firms like JP Chase, I have watched two kinds of people retire. The first kind worked hard their entire lives, saved diligently, and then spent their final years watching their savings slowly disappear, praying the market does not collapse before they do. The second kind, the kind I helped build portfolios for, retired and never once looked at their bank balance with fear. They looked at it with confidence, because every single month, without lifting a finger, money arrived. Dividend income. Passive. Predictable. Powerful. Today I am going to show you exactly how that second group did it, and more importantly, how you can do it too. Here is what we are covering today on Invest with Marcus. I'm going to walk you through a professional blueprint for building a dividend retirement portfolio. This is not theory. This is the exact framework institutional investors have used for decades to generate income that outlasts them. By the time this video ends, you will understand which asset classes to prioritize, which dividend metrics actually matter, and which stocks deserve a permanent seat in a serious income portfolio. So stay with me all the way through, because the final selections I share carry the kind of compounding power that most retail investors never even discover. Before we get into the individual picks, I need you to understand the macro environment we are operating in right now, because context is everything in this business. I have lived through the inflation of the early 80s, the savings and loan crisis, the dot-com collapse, the 2008 financial catastrophe, and the pandemic shock of 2020. Every single one of those cycles taught me the same lesson. When uncertainty rises, reliable income becomes the most valuable thing a portfolio can hold. Right now, we are navigating an environment where interest rates have stayed elevated longer than most economists predicted. That has two effects. First, it has created genuine competition for dividend stocks from Treasury yields. Second, and this is where the opportunity lives, it has temporarily depressed the price of high-quality dividend payers, meaning you can buy superior income at a discount. The window will not stay open forever. The smart money is already moving. Now let us talk about what I call the 4 pillars of a dividend retirement portfolio. After 4 decades of building income streams for institutional clients, I can tell you with absolute certainty that every durable retirement portfolio rests on the same foundation. Pillar 1 is consistency of the dividend. I am not interested in a company that raised its dividend once. I want to see 10, 15, 20 consecutive years of dividend growth. That track record tells me management prioritizes the shareholder. It tells me the business model is resilient enough to keep paying through recessions. Pillar 2 is the payout ratio. If a company is paying out 90 cents of every dollar it earns as a dividend, that dividend is fragile. One bad quarter, and it gets cut. I look for payout ratios below 65%, giving management room to breathe. Pillar 3 is free cash flow. Dividends are paid in cash, not accounting profit. I want to see robust, growing free cash flow because that is what actually funds the check you receive. And Pillar 4 is the moat, the competitive advantage that makes the business nearly impossible to displace. Without a moat, the income stream is temporary. With a moat, it can be generational. Let me now walk you through the specific dividend names I believe belong in a retirement income portfolio built for 2026 and beyond. I am presenting these not as a ranked list, but as a diversified collection of income anchors, each serving a distinct purpose in the overall structure. The first name I want to discuss is Johnson & Johnson, trading under the ticker JNJ. I have watched this company pay and grow its dividend through every major crisis of the last 4 decades. It is a dividend king, meaning it has raised its dividend for more than 50 consecutive years. The healthcare sector provides a natural moat because demand for medical products and pharmaceuticals does not disappear during recessions. People still need medication when the economy slows. What I particularly respect about Johnson & Johnson is the separation they completed with their consumer health division, which now trades separately. What remains is a pure pharmaceutical and medtech powerhouse with exceptional free cash flow and a balance sheet that most corporations would envy. The current yield sits in a range that is competitive with many fixed income alternatives, but unlike a bond, the dividend grows. Over a 20-year retirement, that growth is the difference between keeping pace with inflation and falling behind it. The primary risk here is litigation exposure from legacy product liabilities. I want to be straight with you about that. It is real, but the company has managed legal challenges before, and the underlying business remains fundamentally strong. The second pillar name is Realty Income Corporation, ticker O. This is a real estate investment trust, commonly called a REIT, and it is in a category of its own within the dividend world. Realty Income pays its dividend monthly, not quarterly. For a retiree managing monthly expenses, that alignment of income timing with expense timing is practically significant. The portfolio consists of over 15,000 properties leased to tenants under what are called triple net leases, meaning the tenant pays taxes, insurance, and maintenance on top of rent. That structure insulates Realty Income from the operating costs that erode most real estate businesses. The tenant base is deliberately weighted toward recession-resistant businesses, grocery stores, pharmacies, convenience stores, and dollar stores. People buy groceries and medication regardless of what the Dow Jones does. The dividend has been raised for 30 consecutive years. In my business, we call that institutional-grade reliability. The risk you need to understand is interest rate sensitivity. REITs historically move inversely to interest rates because they compete with bonds for income-seeking capital. In a falling rate environment, Realty Income tends to perform exceptionally well. We may be approaching that environment in 2026 and beyond. Third on my list is Procter & Gamble, ticker PG. I have had this conversation with clients for 4 decades and it always goes the same way. They want excitement. I show them Procter & Gamble. They are unimpressed. Then I show them what their portfolio looks like 15 years later and they stop asking for excitement. This company manufactures the everyday essentials that fill every bathroom cabinet and kitchen pantry on the planet. Tide detergent, Gillette razors, Pampers diapers, Oral-B toothbrushes. These are not luxury goods that disappear during a downturn. They are staples. The pricing power this company holds is extraordinary. When input costs rise, Procter & Gamble raises prices, and consumers keep buying because there are no adequate substitutes that feel as trustworthy. That pricing power is the definition of a moat. The dividend has been growing for over 67 consecutive years, making it one of the longest streaks in the entire market. Free cash flow generation is consistent and substantial. This is the kind of stock you buy, reinvest the dividends, and essentially stop thinking about. Boring is beautiful in retirement income investing. The fourth name deserves particular attention because it bridges the income world with the technology world in a way that most investors miss entirely. That name is Microsoft, ticker MSFT. Now I know what some of you are thinking. Microsoft is not a dividend stock, and 20 years ago you would have been right. Today, Microsoft is one of the most consequential dividend growth stories in the market. The yield may appear modest compared to a utility, but the growth rate of that dividend has been exceptional over the past decade, and the foundation supporting it is arguably the most durable business model in the technology sector. Azure cloud infrastructure, Office 365 subscriptions, LinkedIn, Xbox, and now a deep integration of artificial intelligence across every product line. The recurring revenue model means Microsoft collects subscription fees month after month with extremely high renewal rates. Free cash flow is enormous and growing. A payout ratio that remains conservative means there is significant room for continued dividend increases. For a retirement portfolio built to last 20 to 30 years, having a technology anchor with dividend growth potential is not optional. It is essential. The fifth name is Chevron Corporation, ticker CVX. Energy is a sector that many income investors avoid because of volatility, and I understand that instinct. But Chevron earns its place in a serious dividend portfolio for reasons that go beyond the current price of oil. The company has raised its dividend for over 37 consecutive years. Think about what that streak covers. Gulf War, Asian financial crisis, dot-com collapse, 2008 financial crisis, COVID, multiple oil price crashes. Through every one of those events, Chevron kept raising the dividend. That is not luck. That is financial discipline embedded in the culture of the organization. The balance sheet is among the strongest in the entire energy sector, with a debt level that gives management the ability to protect the dividend even during prolonged periods of low commodity prices. Free cash flow generation when oil prices are favorable is exceptional. The risk is obvious, and I will not sugarcoat it. Energy is cyclical, and commodity prices are unpredictable. Position sizing matters here. I would not overweight Chevron, but as a component of a diversified income portfolio, it earns its seat. The sixth and final name I want to address today is a category rather than a single stock, and that category is dividend-focused exchange-traded funds. Specifically, the Vanguard Dividend Appreciation ETF, ticker VIG, and the Schwab U.S. Dividend Equity ETF, ticker SCHD. I include these because not every investor wants to select individual names, and there is no shame in that. What matters is building the income stream, not demonstrating stock-picking prowess. VIG focuses specifically on companies with a minimum of 10 consecutive years of dividend growth, screening out the dividend traps that destroy wealth. SCHD goes a step further by screening for fundamental quality metrics, including cash flow to debt ratios and return on equity. Both funds offer broad diversification, low expense ratios, and consistent dividend growth at the fund level. For investors who are earlier in their retirement planning journey, these two funds alone can form the backbone of a serious dividend retirement strategy. Now, I need to speak directly about something that concerns me deeply, and I say this after 40 years of watching people make the same expensive mistakes. The content I reviewed in preparation for this video, the kind of content flooding social media right now, is luring ordinary people into highly speculative positions under the banner of investment education. Penny stocks with 500% gains in 1 year. Companies doing reverse splits to stay listed on exchanges. Penny stocks described as the biggest wealth transfer event in modern history. I have heard this language before. I heard it in 1999. I heard it in 2007. Every single time, the people who trusted that language paid for it with their retirement savings. I want you to understand the difference between speculation and investing. Speculation is buying a stock because someone on the internet told you it could go up 10 times. Investing is buying a stake in a durable business with growing earnings, growing dividends, and a competitive position that is difficult to displace. Speculation can make you rich quickly or poor quickly. Investing builds generational wealth slowly and reliably. At your retirement, I promise you slowly and reliably wins. Here is the legacy mindset I want to leave you with today. The goal of a dividend retirement portfolio is not to beat the market. The goal is to build an income stream that covers your living expenses without ever having to sell a single share. When your dividends cover your rent, your groceries, your utilities, and your travel, you are financially free in the truest sense. The market can go up or down, and it simply does not matter anymore because you are not dependent on selling anything. You are living on income. That is what I helped institutional clients build for 4 decades. And that is what I am committed to helping this community build right here on Invest with Marcus. So here is the question I want you to sit with today. If your portfolio stopped growing tomorrow and you could only live on the income it generates, how long would you last? Drop your honest answer in the comments. I read every single one. And in our next video, I am going to walk through exactly how to calculate your personal dividend income target and reverse engineer the portfolio you need to hit it. Subscribe to Invest with Marcus right now and turn on the notification bell. This community is building real wealth, and I do not want you to miss a single step of the blueprint.